Hi students, welcome to Radhakrishna Edutech. Today is a class 4, okay? So we will be calculating the purchase consideration. This illustration I have taken from one of the professional course illustration. So we will discuss how to calculate purchase consideration and we will pass a journal entry. If possible, they have not asked anything about the balance sheet here. So basically we will target to understand purchase consideration as well as journal entry posting. Okay, so here in this I'll just explain the illustration here. So here we have to calculate a purchase consideration. Purchaser is A limited and the seller is vendor is B limited. This is both are limited company, so we can consider this is an amalgamation. So A is acquiring B limited. So here first thing, equity, this is all liability and this is the asset amount, and these are the below agreed terms and conditions for acquiring A limited, for acquiring B limited by A limited. Okay, so this is a B limited balance sheet. So equity 1500 equity at 10 rupees, so 15,000. Preference share 750 preference share at 10 rupees, so 7,500. And reserves and surplus 9,000. This is we can assume nothing they have given. We can assume there is a general reserve. And under non-current liability 15% debenture of that is a 7,000. So current liability, trade payables 5,000. So in non-current asset we have LNB, so land and building 32,500, and this is an investment of 6,000. So current asset we have a stocker in inventory at 2,000 and trade receivable 2,000 and cash or cash equivalent 1,000. So total of this is 43,500 and 43,500. Okay. So this below are the agreed terms and conditions for acquiring. So first, land and building at 10% above book value. So A limited is acquiring B limited by giving a 10% of the land and above book value of 10% they are giving to B limited. Second, investment at book value itself, so directly 6,000. So current asset at less than 10% of book value. So whatever the current asset is there, they will be taking a 10% of the book value excluding cash. So cash will be considered as it is because it won't depreciate. Okay, so next is current liability at book value. So current liability only one we have, that is trade payable, so 5,000 will take as it is. Then below this purchase consideration is paid based on this below data. So preference share, so they are giving a preference share 10% premium at book value. So whatever they had at 7,500, right? So plus 10% of premium they are going to give it. So now we have to calculate a net asset, and that how it is will be paid we can assume based on this line items. So now we have, for example, net asset what 100 minus 75, so 25 your net asset you think. So this 25 is paid through preference shares, equity and cash. So we will not consider debentures because debenture will be not be a part of your purchase consideration in limited companies. So as it is A limited will be acquiring B limited, whatever the B limited debenture will be moved to A limited. So they will not pay anything to debenture holders. Okay. So first thing, preference share at 10% premium of book value. So equity share, issue 3 equity share for 2 equal share of B limited. So whatever the B limited having, for that two shares they will be giving a 3 equity shares. So balance in cash. So balance in cash, debentures equal as book value at 10% premium. So 10% premium they are going to give the debenture holder, but debenture will be not considered your mode of payment to your purchase consideration because it will be transferred directly from B limited to A limited. Okay, so this is a illustration 1. So first what we have to do, we have to calculate net asset. So I will put it here, calculation of net asset. So net asset, so in this formula they have not mentioned which way we have to calculate a purchase consideration. So we can directly consider this a net asset basis. Based on net asset mode, they are going to calculate the purchase consideration. So first thing we will tell what they are 10 LNB at first item what we have LNB we have, right? L and B. So what is your book value? 32,500, but here 10% above book value. So 32,500 into 10%, that is 3250 is equal to, this is your now 32,500 plus 3250. So if you put together, this is your current asset value, current value. Okay. So 32,500, I will just put it 35, 37, so 33, 32 plus 3, 35, 750. Okay. The second item what we have investment. So just see investments, they are taking it or not. So investment what at book value. So don't just, it's a 6,000. So no into, so nothing. So it's just a 6,000. Just put it directly 6,000. Okay. Next, current assets. So current asset what and all, what they are tell, current asset less than 10% book value. So sorry. Stock or inventories. So 2,000 into 10%, it is nothing but 200. So 2,000 minus 200, so that is equal to 1,800. So next, trade receivable. So what is your trade receivable? Same thing, 2,000 into 10%, nothing but your 200. So 2,000 minus 200, that is your 1,800. Okay. Then cash. Cash directly 1,000. So now total asset. How much we have? Total asset. I'll just put it here, okay? Zero, 5, 8, 8, 16, 16 plus 7, 4, 23, 2, 7, 7 plus 6, 13, 14, 15, 16, 46, 350. This is your total asset. So now total liability. So what is your liabilities? So for liability, what they are at book value directly. So they are taking only current liability. Okay, current liability, trade payable 5,000. So directly you can put it up, trade payable. So 5,000. So now net asset. So 46,350 minus 5,000. This we have to reduce this. So 41,350. So this is a net asset. This is a PC for this company. So A Limited is going to, net asset is directly nothing but your purchase consideration. This is what they are going to pay to B Limited. But this item will be paid in this mode: preference share, equity share, and balance in cash. They are given debenture, but debenture will be not be considering a mode of payment. That will be directly transferred from B Limited to A Limited. Okay, it's very simple. So this 41,650 is there, right? So we have to consider this in. First thing, preference shareholders, we have to give a preference shareholders, we have to give a priority. So directly give it a preference share, 10% premium plus book of the book value they are telling. So what is your book value? 7,000. So mode of payment you can tell, mode of payment of above PC. So this PC. So first thing, preference share. at 10% premium. So 7,500 into 10%, that is equal to 750. So 7,500 plus 750 is equal to 8,250. 8,250 preferential value they are going to give at same rate only. So at 10 rupees rate only, but there is a premium for that. That's it. And next item, what is there? Equity share. Issue 3 equity shares for 2 equal shares of B Limited at 10 each. So currently also they have 10 each only. So equity shares, what you are going to do? Equity shares. So total how many shares have B Limited is having? 1500 shares, you think. So 3 equal shares of B Limited. So they are going to 1500 shares B Limited is having. So for each 3 shares they are going to pay 2 shares. So divided by 3 into 2. So divided by 3 how much? 500, right? So into 2. So nothing but 1000 shares at 10. So that is 10,000. So remaining last item, what they are telling, they will pay balance in cash, it seems. So this put together you have 18,250. If you reduce 41,350, balance whatever is there they will pay through cash. So when I explained in last time, if they don't have the cash, they will when you are passing a journal entry, you can show that they have borrowed the amount from the respective and a bank or any other institution, and you can pass a journal entry for that. So bank or cash. So how much put together this 18,250, right? Somewhere I will write this, okay? Here itself I will write. For calculation purposes, I am just putting here 41350 18,250 001 11 minus 3 11 minus 8, it is 3 2 2300. So cash, bank or cash, they are going to pay in 2300. So 8,250 in preference share, 10,000 in equity share, and balance in cash 2300. So put together this will be 41,350. So first you have to calculate what is your current total asset based on your agreed value, then reduce that current liability based on agreed value. That amount will be considered as a PC. For that PC, that is paid through these modems, that is preference shares, equity shares, and bank and cash. Dividends will be not considered, so that will be directly transferred from B Limited to A Limited. Understood? So what I am going to do here is, I just wanted to put up a different journal entry, okay? So I'll try to write it some here only, but I'll just transfer all these numbers here. So 35,750. If we have 6,000, so 1,800, 1,800. We have 1,000. So net 46,350. So trade per total asset is 46,350, 5,000. So this is total trade payable. Your PC is 41,350. So I'll use this question for posting journal entry, okay? Journal entry. So first asset, I'll give direct directive. Total of asset, LNB, current asset, stock, total put together how much you have? 46,350. this is your debit, this is your credit. So liability, so because it is the debit side, because we are increasing in assets, so that is debited. So trade assets increasing, trade receivable current liability, so we are increasing it. So trade payable, that is 5,000. So difference is vendor account, nothing but your transfer PC value. So that is 41,350. That's it. In this, no calculation of goodwill or nothing. So directly we are considering that is as a PC. So 5,000, 41,350. So now you can directly tell. Suppose they have not given anything. If they, for example, now they are asked, they are paying through bank balance entirely. Suppose direct lump sum amount they are given. I am paying only 40,000 for them. Or you can tell 18,250 plus balance in 12,000 in cash, you think, for example. So that to put together it is coming 40,000. But remaining amount, you don't know. Remaining amount actually you had to pay 41,350, right? 41,350 had to pay, but you are paying only 40,000. For example, now you see how you will calculate that goodwill or capital reserve. I will tell you. Now 46,350 your net asset minus 5,000 your liability. So 41,350 is your net asset. This is, we are considering it as PC. For example, they are given in the sum that 8250 is your equity. Then 10,000 is your, 10,000 is your equity. 8250 is preference. Okay, so put together you have one value. So then they are telling in cash we are paying some 11,750. So put together this is 40,000 they are going to pay, but you are going to, you need to pay 41,350, right? But you are paying only 40,000. So 1,350, what you are doing? You are paying less. So in that scenario, this will be considered as capital reserve and will be coded here, capital reserve account for the difference of 1,350 if this value is 40,000. That's how it is to be considered. For example, suppose instead of 41,000 they are paying, they'll tell I am paying a cash of how much? 25,000, you think. So put together it is coming around 45,000. Example I am giving. So if you reduce this value, you will have some 3,650. So you are paying more than your current PC, right? So this will be considered as goodwill. This will be accounted in asset side. That's it. So this is simple. So balance directly they are told that they are paying to cash. So they are just netting off with your assets. So you don't need to think about goodwill or capital reserve. Directly you can post your entry. So this is done now. This is asset account debit, account debtor to 46,250, liability account 5,000, vendor account credit 41,350. Now second entry, vendor account. Vendor account is getting offsetted with 4,350 and it is offsetting with these modules, right? So equity 10,000. Then preference, how much you have? 8,250, cash 2,300. So this is offsetted. Okay. So this asset, everything looks good. Now you don't have this cash in your account. So what you will do? How you are paying it? You don't have it. So you are taking a bank loan from that. So cash account 2,300, bank loan 2,300. This is a credit side, so it is increasing your liability. So it is in credit. This is increasing in your asset, so it is in debit side. So 4350. That's it. So this is very simple. So if you just transfer all this into your new balance sheet item also it will match. So put together, so for example this is your balance sheet you think. So asset side what you will put, 46,350 you will put. Okay. Second what you will put, you have a cash also you will put. Cash is getting net set, so you will not put that. So liability also you will give your liability. So what is your liability? 5,000, right? So 5,000 your liability. Then equities you are giving equity 10,000. Then preference share 8250. Okay, and then bank loan, if you put it in your liability say 2,300. So if you put together, this will be 46,350. So this I given in total value. If it will be LNB 3570 investment separately you can put that numbers and you can show it off. Okay. So I hope you understand this. So it is simple. They are giving your balance sheet of your vendor account. So and they are given you the agreed value how they are going to take over. Based on that you have to calculate your net asset, and that net asset will be considered as PC because they are not given it's a problem itself. This is your total PC only. So that net asset, that PC will be paid through preference share, equity shares and balance in cash. Then you have to calculate that what is that values, and so cash they don't have in your account, so they are taking a loan for that, and for that loan also we have posted one bank loan also we have posted on journal entry. That's it. So this is simple, so no need to worry about this. So if you keep practicing how to calculate your purchase consideration, so it will be very easy. So total asset minus total liability at agreed book value or agreed value or agreed book value, that will be considered as a PC if the nothing is given in your sum. If they already given it, this is your lump sum amount, so you should net off with your net asset and what actually paid. If it is more than that, it will be a goodwill. If it is less than that, it will be a capital reserve, and you can post just based on this calculation you can post your journal entry. Journal entry nothing but all your assets will be debit, all your liability will be credit, vendor account always it will be credit. So for that vendor account it will immediately get offsetted with how you are making the payment to them. That's it. Thank you. This is a class 4 for your journal entry, purchase consideration and balance sheet idea. So going forward, I will be next classes we will be discussing about amalgamations. How we will be calculating the we'll understand basic concept of amalgamations, and how we are going to calculate the amalgamation sums and presentation of balance sheets also. Okay. So thank you very much. So please like and share. Welcome to Radhakrishna Edutech once again. Thank you.